Good morning and good evening, everybody. We're going to give everyone a few moments to dial in, so bear with us. Again, good morning and hello, everybody. This is Joan Larea, and I'll be starting in just a moment. We just wanted to give people a couple moments to join us. Okay, I think we should get started. So again, hello, everybody. My name is Joan Larea. I'm the CEO of Convergence Blended Finance. And we are here today to present to you our annual State of Blended Finance report. If I could ask for the next slide, please. So before we start, let me remind everybody of some housekeeping tips. First of all, you might have noticed you're being recorded. We will record the entire event and then share the recording with everybody who participated afterward. Please, while you're waiting, please rename yourself on your tile with your full name and your institution so we know who we're interacting with and so that others know who is on the call. Also, please make sure you put yourself on mute and turned your camera off so that everybody has the benefit of the best audio and video that we can do on a call of this size. It's a big crowd. And finally, when we get to Q&A, and there are going to be two separate sets of Q&A today, please use the chat function that Zoom offers to ask whatever questions you have. And finally, if you're wondering where the report is that we're talking about, you can find it on our website. It's www.convergence.finance/resource. You can also find a whole lot of other useful material there. So if I could have the next slide, please. All right, let me quickly run you through the agenda for the morning. We're going to get you out of here in 90 minutes flat. After I give you a few opening remarks, I'm going to turn over to the knowledge and content team to present the key findings of the report. After they speak for about 20 minutes, you will have an opportunity to put questions in the chat line. Please, if you're not interested in asking questions, hang with us because there's going to be a wonderful panel thereafter. I will moderate it, but you have four really interesting voices from the community of blended finance that you can hear from, and you will have a chance to ask them questions as well. And we will wrap it up at about 10:25, 10:30 a.m. Eastern time. So next slide, please. All right, so first of all, let me make sure that we're all starting off on the same page. We realize that not everybody lives in blended finance world all day long as we do. So when we are talking about blended finance at Convergence, because of our particular mission, what we're talking about is any kind of use of catalytic money, which could come from a philanthropic institution or a development agency, the use of that kind of money to increase private sector investment in sustainable development, and we focus on the developing economies of the world. So based on that definition, we publish an annual report of the state of the industry by adding transactions to our proprietary database of knowledge on all the transactions that have happened out there in our markets that match our definition. This is our 6th edition. We started doing this in 2017. It's the first time we've ever actually written a State of Blended Finance report that has a theme to it. And the theme, as you've noticed, is climate. So why climate? A couple of important points. First of all, there's a large component of blended finance that touches on climate change themes. Second of all, that is climate finance is the area where investors, particularly large institutional investors, have indicated that they are willing to try to stretch their mandate and go into our markets. So we have a wonderful intersection and a wonderful opportunity in front of us to do something significant. Now, we know that we aren't climate scientists, and we also recognize that we are not climate finance specialists. There are many other institutions who can do a wonderful job of explaining what's going on in those two fields much better than we can. But this is a subject that we feel needs everybody's attention, and it also intersects with so many other SDGs, much as gender does. And we are concerned that if we don't all pull together and work on the climate change issue, we're actually going to slide backward on many of the targets under many of the other SDGs. So we feel this is an all hands on deck moment, and it deserves our full attention. I'm going to turn over now to my colleague, Nnamdi Igbokwe, excuse me, Nnamdi, who is our Director of Knowledge and Thought Leadership. So Nnamdi, over to you.
Thank you, Joan. Good morning, good afternoon, and good evening to everyone. My name is Dr. Nnamdi Igbokwe. I'm the Director of Knowledge and Thought Leadership, and I lead the content team here at Convergence. I'd like to, again, thank you for joining us as we launch our annual State of Blended Finance report. By now, you know that this year's report is climate themed, and the reason for this shift will become apparent as we move through today's presentation. But broadly, climate finance, development finance, and blended finance have become increasingly aligned. So over the next few minutes, the team at Convergence will present key findings, trends, and insights on climate blended finance, contrasting mitigation and adaptation. I'll begin by giving an overview of some key challenges that we've identified. And as we illustrate themes across climate blended finance, we ask that you keep some of these challenges in mind to best contextualize the insights and perspectives of the report. Let's get started. So last year, Convergence presented 4 challenges to achieving scale in the overall blended finance market. This year, building upon that analysis, Convergence has identified 6 key challenges to scaling climate blended finance, and I'll highlight 3 of them here. The first challenge refers to capital mobilization plans. Now, the positive is that the private sector, perhaps more than ever, is at the table. The appetite is there, the interest is there. They like to invest in climate alongside with the development community. The negative, however, is that there's been a lack of strategic coordination to mobilize and integrate the private sector. Now, public and private sector remain mostly disconnected in this regard, and the use of catalytic funding has not been optimized. Better alignment and improved coordination will be key. The next challenge is the lack of domestic participation. Now, representation and expertise from local stakeholders in developing markets remains a crucial component to scaling climate blended finance. From their understanding of local financial landscapes to their ability to invest in local currency, domestic market players play an invaluable role in helping foreign investors navigate communities, navigate governments when structuring a climate blended finance transaction. And the final challenge is in regards to managing trade-offs. So one question that arises is, how do we manage the trade-off between blended finance for climate versus blended finance for other development goals? Most climate blended finance is focused on middle and upper income countries, while LDCs bear the largest burden of climate effects. So how do DFIs and MDBs prioritize poverty as a central goal and ensure it's being incorporated alongside mandates for climate? Addressing multiple development goals in this manner will at minimum require tough, challenging decisions to be made with regards to deal making. There are 3 additional challenges that we have identified, and we go in far more detail within the report. But with that context in mind, I'll pass it over to my colleague, Nick, to begin the discussion of market trends.
Thank you, Nnamdi. So my name is Nick Zalinchuk, and I'm a senior associate on Convergence's content team. I'll be taking us through some overall market highlights on the climate blended finance space from this year's report. Next slide, please. Climate change has consistently been a thematic focus of the blended finance market. In the last decade, climate-focused transactions have accounted for half of annual deal count and notched around $7 billion in total annual deal value. But over the past 3 years or so, Convergence has witnessed a decline in aggregate financing levels for climate blended finance. Since 2019, total financing volume for climate blended finance has totaled just $13 billion, compared to $36 billion invested between 2016 and 2018. A notable anomaly to this trend was the spike in adaptation financing over the past 3 years, which saw financing volume for adaptation expand by over 70% from previous totals. Again, this will be explored in greater detail later on in the presentation. Next slide, please. The economic effects of the COVID-19 pandemic in part contributed to the decline in financing volume in recent years. As part of our research for this year's report, Convergence surveyed its membership to ascertain some of their insights and experiences from the field, including what other factors might be fueling this drop. Respondents identified the lack of investable opportunities with appropriate risk-adjusted returns as the leading barrier to more systematic participation in climate-blended finance. In the context of these challenges and new ones presented by the current macroeconomic environment, blended finance should present a promising means to increase investment flows to climate-related projects in emerging markets. Next slide, please. So this year's edition of the report also explores the various dimensions of Convergence's own historical deals database through the lens of climate-blended finance. This includes the types of blended finance vehicles used in climate-blended finance, the direct and indirect recipients of climate-blended finance flows, and the regional distribution of climate-blended finance activity. Today, I'll be sharing some of our findings from the regional breakdown of climate-blended finance. As can be seen here, Sub-Saharan Africa hosts more climate-blended finance transactions than any other region. Latin America and the Caribbean, too, was a key region of activity for climate-blended finance deals. In both these regions, mitigation blended finance transactions have been the central focus, accounting for about 60% of deals in both of these regions. Notably, mitigation does drive the climate blended finance market across all the regions. Interestingly, despite the deal count disparity between Sub-Saharan Africa and Latin America and the Caribbean, the total financing volume is actually relatively comparable. This suggests that transactions in Latin America and the Caribbean are generating real investment appetite from investors and are trending in the right direction towards scale. So this regional analysis and other analyses across a breadth of data dimensions can be found in the report. I will now hand it over to my colleague, Andrew Pampa, who will dive a bit deeper into the mitigation and adaptation blended finance sub-themes.
Thank you very much, Nick. My name is Andrew Pampa. I'm a manager on the content team here at Convergence Blended Finance. In this year's report, we conduct a deep dive into mitigation blended finance and adaptation blended finance, analyzing deal and investor types, addressing fundamental challenges to catalyzing private capital, and also exploring viable opportunities for scale. First of all, most climate blended finance occurs in the climate mitigation space. As we can see from this, 56% of all climate deals captured by Convergence have targeted mitigation. Blended mitigation deals have also consistently represented the largest transactions in climate blended finance by size. The historical median size of mitigation deals is around $93 million versus $79 million for adaptation deals and $65 million for hybrid adaptation mitigation deals. Meanwhile, adaptation continues to be underdeveloped in climate blending, both in terms of deal flow and deal value. As we can see from the slide, only 14% of blended climate transactions to date have had a pure adaptation focus. Only $6.9 billion of the overall $108 billion in aggregate financing that has been mobilized for blended climate transactions to date have gone to pure adaptation transactions. However, in the report, we explore how investments into adaptation are actually 72% higher between 2019 and 2021 compared to 2016 through to 2018. We've witnessed adaptation finance deals begin to evolve from the domain of niche innovative deal structures financed by subject matter specialists to scaled instruments that meet the risk adjusted return expectations of larger private sector investors. Next slide, please. Mitigation blended finance has historically comprised the largest subset of climate blended finance, as I just mentioned, both by annual deal count and also by aggregate annual financing. From this slide, we can see that between 2019 and 2021, renewable energy transactions accounted for 88% of mitigation blended finance deals. 89% of all of the fundraising climate deals that we track target renewable energy assets. Of course, the transition away from fossil fuel power generation to renewable energy alternatives is one of the key aspects of climate change mitigation, making it easily marketable and translating into a robust pipeline of investable projects. What we can also see from this slide is that solar power generation has been the most common renewable energy technology funded by blended finance since 2016, making up 74% of renewable energy deals. Of course, economies of scale, more efficient supply chains, and technology improvements have significantly lowered the production costs of renewable energy components, benefiting subsectors like solar energy. Next slide, please. As I mentioned before, only $6.9 billion has been mobilized for transactions purely focused on adaptation, of which only $2.5 billion came from the private sector. As we can see from this slide, agriculture has been the major area of activity in adaptation blended finance in recent years. Agriculture, forestry, and land use is the second largest source of greenhouse gas emissions and the main driver of biodiversity loss. Agribusinesses are also under increased pressure to ensure sustainability within their supply chains. Within adaptation blended finance, subsectors like agricultural inputs and farm productivity, climate resilient and sustainable agriculture, and agroforestry have been particularly prominent. As we can also see from this slide, smaller subsectors like fisheries and aquaculture, which accounted for only 6% of blended adaptation and hybrid transactions in 2019 and 2021, are also represented in terms of adaptation transactions. In the blue economy, early stage and small to mid-sized enterprises are particularly prominent, with capital costs being relatively higher and economies of scale in many small island developing states being limited, which explains the low number of transactions in the field. I'd like to stop here and hand over to my colleague Aisha Berry, who will take us through the next part of the presentation.
Thank you, Andrew. Hi, everyone. My name is Aisha Berry, and I'm also a manager on Convergence's content team. And today I will walk us through the final component of our data analysis, which is focusing on investment trends in key organizations in climate blended finance. So if we move to the next slide, our analysis finds that the use of blended finance as a tool when supporting climate outcomes, as with the entire market, has not become routine. So what we mean by that is most investors tend to participate in climate blended finance on a one-off basis. So 63% of organizations have only made a single commitment to blended finance, climate blended finance, and only 22% have invested in 3 or more deals and are therefore classified as active investors. This repeat activity is mainly supported by the development finance community, that is development agencies and MDBs and DFIs, which becomes evident when we look at the league tables of the most frequent investors, which is disclosed in our report. So if we move to the next slide, we can move into investment trends generally amongst the different investor groups. So our analysis finds that overall, investor commitments into climate blended finance has not changed substantially over time. So we don't see any specific investor category demonstrating a significant proportional uptick in their activities when we compare 2016 to 2018 and 2019 to 2021.
Hey, Renee,
when looking across investor groups by share of commitments into blended finance, commercial investors, which encompasses a range of private investors, including financial institutions, corporates, and institutional investors, continue to have a strong presence in climate blended finance. And this is because every blended finance transaction has participation from at least one private investor in our database. However, the financing levels from commercial investors have dropped significantly, which we'll explore in the next slide. Meanwhile, MDBs and DFIs provide the bulk of commitments from the public sector. So 60% of public commitments are coming from MDBs and DFIs, with the remaining 40% coming from development agencies. Looking specifically at concessional capital into blended finance, this comes mostly from development agencies. So they're providing 55% of commitments since 2019. But we also see an outsized representation coming from philanthropic organizations who have provided 15% of concessional finance commitments into climate blended finance. So if we move to the next slide, here we're doing a deeper dive into commercial investors specifically. So a few takeaways from this slide. So firstly, we've noticed a shift in where the share of commitments are coming from in terms of private investors into climate blended finance since 2016. So notably, both commercial financial institutions and corporates have declined by their share of commitments. So commercial financial institutions have reduced their share from 36% to 29%, and corporates from 32% to 17%. And this really is underpinning a decline in commercial financing levels overall. So between 2016 to 2018, we saw 19 billion going into climate blended finance from the commercial investors, and only 4 billion between 2019 and 2021. So in our report, we hypothesize a few reasons for this trend. So one could be that commercial financial institutions might be participating in climate finance without blended finance, requiring less concessional capital. And we also see corporates participating in transactions as deal sponsors rather than investors. So they might be financing initiatives through facilities that are being extended a line of credit from financial institutions or MDBs and DFIs. Of course, this doesn't mean there isn't a role for blended finance to support investors taking on new risks. So for example, investing in project finance at the development stage rather than the construction financing or refinancing stage, as well as a continued opportunity for more local financial institutions to play a role. On the other hand, we do see the share of commitments coming from institutional investors and private equity and venture capital firms increasing proportionately. And this really reflects some of the public chatter from zero asset institutional investor groups, such as the Net Zero Asset Owner Alliance, which includes pension funds and insurance companies. The last trend that I'll focus on today is where investors are focusing from a specific climate finance perspective. So if we move to the next slide, we'll see that all investor groups, not surprisingly, have predominantly invested in climate mitigation transactions, while adaptation deals remain underrepresented. Even when we look at public investors, hybrid models with cross-cutting themes are becoming more common. So commercial investors, foundations, and impact investors all demonstrate good appetite. Around 30% of financial commitments are going into hybrid models. So I'm going to hand it over to Namdi again to walk us through the recommendation section of this report.
Thank you, Aisha, Andrew, and Nick for that incredibly insightful overview. Now with a better understanding of the climate blended finance market, I'll offer 3 of the 6 recommendations that we've identified in the report in thinking about what steps the donor and investor communities can take to build climate blended finance transactions that scale private financing and achieve climate outcomes more effectively and efficiently. First recommendation is around high-level mobilization plans that must translate into action to deliver private sector investment. A central theme in these mobilization plans is deploying a tangible portion of public development finance to de-risk investment opportunities. Blended finance must feature prominently and strategically to maximize outcomes given the limited amount of concessional resources. This requires primary providers like OECD DAC members and donors to climate funds like GCF and GEF to come together to award funding more effectively. Second, donors' involvement must track NDC priorities. So donors have to be better about directing concessional funding in a way that is responsive to where capital is aligned with NDC priority areas. In this sense, blended finance can lead the way in integrating local voices. And finally, we recommend that development agencies should be definitive about their climate agenda. Those managing catalytic funds who intend to use blended finance must be clear and coherent in their signaling to private sector counterparties. Now, again, we go through a much more robust discussion of all 6 recommendations within the report, along with associated actions. But we thank you for your attention, your continued collaboration, as we strive for action-oriented blended finance solutions to the ever-pressing issue of climate. Now, before we open the floor to questions, and we ask that you do submit them in the chat, we will remind you that there is going to be a panel discussion immediately following, touching on many of these issues around recommendations, around challenges, and around a lot of the insights that we have presented here today. So with that, I will open the floor to questions at this time. We're filtering through quite a few. Let's start with one that has come up quite often, actually, and that is, do we expect the trend in climate blended finance to continue? meaning the decrease that we've seen in looking across the last few years. The overall market is going to struggle. We know that due to the macroeconomic shocks, post-COVID-19, the conflict in Europe, climate finance will struggle, blended finance will struggle, that we know. We don't expect immediate rise, but what we might see is yields that push things forward in the future. Adaptation has massive potential. At this scale, every deal does count. It'll take a few large-scale deals to move the needle forward, or a few donors to step up in providing increased amount of catalytic capital to push participation. But as far as the trend, there's not going to be an immediate turnaround, but there is massive opportunities, especially in the adaptation space. Going through a few more questions.
Nnamdi, this is Joan. I think there have been several questions asking about what we mean by hybrid. Perhaps you could address that.
Sure. So the divide that we see is obviously adaptation versus mitigation in terms of climate blended finance. When we speak about hybrid, what we're really talking about is the not necessarily the overlap, but the intersection where we're looking at resilience, but we're also looking at conservation models, and we're looking at areas where mitigation and adaptation can intersect in a way that blended finance comes to the table to respond to some of those climate-related issues. Of course, I'll open it up to fellow members of the content team if they want to add to anything there.
I think we also have a question about what kinds of vehicles would we expect to work best in bringing philanthropies and pension funds and their like into this realm. Are there any examples? Maybe you could think about what kind of structures are best to do that.
So, philanthropies have a huge role to play in blended finance. Of course, their capital acts a bit differently, a bit more patient. When we speak about the quantum of catalytic capital that is needed to really push things forward, philanthropies play a huge role there. In terms of the vehicle type, it's really looking at pension funds and other institutional investors, and some of the standard archetypes that we use, either as a first loss capital or as a provisional grant, especially in adaptation. We do know that technical assistance is going to be very highly required. So grant catalytic funding is going to be a huge component in terms of bringing pension funds and other institutional investors to the table.
Yeah, and just to add to that, I think that fund structures probably are very useful in that kind of a situation because they get smaller opportunities up to a scale where a pension fund can look at it as a viable opportunity.
There's also some questions, Nnamdi, about what we see in terms of climate blended finance and LDCs in low-income countries. So maybe it would be relevant to bring up some of the trade-off benefits we considered in our report, given that the majority of climate finance is going into middle-income countries and upper middle-income countries, but we know that the burden is being faced by, the greatest burden of climate change is currently being faced by LDCs and low-income countries, and how to sort of reconcile that trade-off, and something we'll certainly explore in our panel as well.
Yeah, that's a huge consideration and a great question. Of course, that trade-off in terms of, areas that bear the greatest burden of climate effects, and then the areas that see the greatest investment into climate, it's not congruent. And what really needs to be done is donors have to be better about that alignment. We see the just energy transition partnerships that have come around, and there is some benefit there, and there is some optimism as well. But really, it's aligning more directly with the priorities of NDCs and allowing local capacity and local stakeholders a seat at the table to really direct where some of this financing can go. And that's where blended finance really comes into play. is that it can lead the way in integrating those local voices and bridging that gap that we've seen when we talk about NDC priorities and we talk about local capacity building. Are there any other questions before we move over to the panel? Again, many of these that are coming through will be discussed in our panel discussion. So trying to stay away from stepping on that portion of the presentation just yet, because it's going to be a really insightful conversation across the board there.
Maybe one final question we could address is that on returns. There's some questions on what we can expect from funds, private equity funds. And I think that this also reflects one of those challenges that we see in terms of transparency in the market. Now, maybe we can share a couple of thoughts on that challenge in the report.
Can you rephrase slightly, Aisha?
Yeah, there's a lot of demand for information on what the returns profile looks like, and it's something that Convergence is certainly trying to reconcile, given that a lot of the information that we collect is public and I guess not disclosed. And I think it points to that overall theme of lack of transparent data, and particularly on climate finance structures. And really, that's what's necessary to bring in more of those institutional investors. So I thought just worth speaking that it's a data point that we hear again and again, and we want more information on, but we find that the availability just isn't there.
Yeah, that's a great point, and it's a challenge that we cover in the report. Transparency, disclosure, data has always been an issue. There's silos that exist across, well, within development finance in general, but certainly across climate finance. When we think about adaptation, mitigation, impact metrics, these things have not been uniform, and in order to get a more clear and insightful sort of demonstration of where transactions can be successful, we need to increase that transparency. Effectively, there should be a sort of open sourcing that looks to create an availability of data to the point where it can be shared, learnings can be taken, and transactions can be replicated. It's something that's going to start with each stakeholder. And we do hold ourselves also responsible in that regard in terms of being able to provide transaction data. So really, we're looking at each stakeholder in public and private to be able to be a bit more open and transparent. When we think about climate blended finance, you can't manage what you don't measure, and you can't measure what is not standard. So standardization is going to become key, but before you can get to standardization, there has to be more disclosure, there has to be more transparency. Okay, I think with that, we will shift to the panel discussion. And for that, I will give it back to our CEO, Joan.
Thank you very much. And I really love the way people are answering each other's questions in the chat line. Many of you, as I said at the opening, are better experts than we are in climate finance and certainly in climate science. So thank you for being part of the conversation on the sidelines. I am delighted to bring out, and I would ask you to turn on your video, maybe keep mute for the moment, Cruzcaya Sierra Escalante, who is the Senior Manager for Blended Finance at IFC, Lauren Verstandig, who is the Managing Director at NatureVest and the Nature Conservancy, Leticia Ferreras, who is the Vice President of Development Finance at Allianz Global Investors, and Tanya Kothari, who is the Regional Manager for India for Shell Foundation. We have several different voices here, and we are delighted to have all of you as people who are actually doing transactions in this space. So if I could ask each of you, if you're not on video, yes, you are, great. Okay, so thank you for being here, welcome on board. And obviously, you are not responsible for our report, but we really want to hear your voices come forward. Several of you actually did contribute thoughts into the report, and we appreciate that as well. So first of all, let me start with Leticia Ferreras at Allianz Global Investors. As you actually said in our State of Blended Finance report, country risk continues to be the biggest risk for private investors, particularly large ones like Allianz Global Investors, when you're thinking about doing climate investing in emerging markets. So where do you see blended finance having the best opportunity to be a good tool to get you to bridge that gap, to confront that country risk? And where is the opportunity to get more private investors like yours into climate in these developing economies? Maybe you could help us understand what things look like from your perspective. Sure.
Thank you, Joan, and thank you for having me here today. I think some of the discussions that we're having also in the context of the report is that in the context of climate specifically, many investors, I would say, are familiar already with climate investment. So when we think about, just to put as an example, renewable energy, renewable technologies, they might already be doing this kind of investments in OECD or developed markets. So that is quite a benefit, because then you kind of eliminate or at least mitigate one of the risks in terms of them being familiar with what energy projects would look like or the technology itself. So what we see is that there is still, while they're familiar with this asset class or this sector, they tend to be still very much concerned around country risk, regulatory risk, and more of that emerging market, perceived risk that we often talk about in this kind of forums. So we find that there's still a very, very important role that blended finance can take in as a technique in order to help us de-risk these investments. And this is still kind of the same theory that I would say both for climate as well as other themes and other sectors that we're also trying to promote in order to support and achieve the SDGs. So we find that while there is a lot of interest in climate, there's also a need for that de-risking in terms of sectors and overall credit risks that our investors are very focused on. However, what I like to say is that I think there's a very strong positive here, and that's that there's a strong momentum from a lot of investors in terms of how they see climate and their commitment to climate. So, I mean, as has been mentioned in the findings and also on the side chat, there's a lot of commitments from institutional investors, especially with regard to net zero portfolios. We saw that in COP26 last year, and I'm sure it'll be similar this year, where there's a lot of capital that has been committed to be deployed to emerging markets. So there is already that push factor from the investor side to commit towards mitigating climate change. And also, to be honest, if I can call it social pressures as well, I think our investors are increasingly more and more more and more aware that from their own clients, when we think about pension funds or insurance companies, there's that push towards doing something about climate, and blended finance solutions and well-structured vehicles can really bring us there.
Just to jump on some of that commentary, without tools like blended finance, is it more likely that you just stay in the OECD economies and safe places?
My general answer would be yes. There would, of course, there's caveats. I think we see some investors that have, non-blended funds or non-blended fund investments in specific countries where they feel maybe more comfortable within certain emerging markets, a lot smaller funds, a lot smaller commitments. So there are some caveats to that. But I think when we think about catalyzing scalable private capital towards emerging markets, then the need for blending still remains there.
Okay, thank you very much, Leticia. Let's go to Lauren at NatureVest next. Can you tell me a little bit about how NatureVest's approach to structuring climate transactions has changed over time? I mean, have you had any limitations in trying to access the catalytic money you need? What's the best way of getting that kind of funding in so that you can pull the transaction together?
Sure, and I will address the second part of the question first, and then talk about how we have approached structuring the transactions, because they're actually related. So the answer is yes, there are absolutely limitations to finding catalytic funding. I think that has been one of the trickiest things for us in certainly structuring blended finance transactions, but also working in LDCs because blended finance is so critical for working in both higher risk geographies, but also higher risk sectors. Obviously, you know, the tricky thing is obviously we're asking for folks to take on a higher percentage of the risk. We can find that one thing that the Nature Conservancy is lucky enough to have is, you know, a broad base of supporters. We are able to find folks that are willing to take on the risk, but usually not at scale. When we're talking about doing scaled transactions, and I will say there are some, you know, notable exceptions, but when we're talking about doing scaled transactions, usually our opportunities for blended finance rest with the development finance institutions or the multilaterals. And they have been fantastic partners for us. I will note our Blue Bonds work has been supported. We've gotten political risk insurance, guarantees from the US government, from the Inter-American Development Bank. They've been fantastic partners for our work. But, you know, there are limitations to what the DFIs can do and the speed at which they can work. And, you know, I saw on your recommendations, one of those is it's important for the DFIs to get their climate agendas in order. That has been something that has slowed us down a bit. I think climate is now very, very important on the agenda for the DFIs, but it's relatively new. And so we've been kind of walking slowly with the DFIs as they've been figuring out what the priorities are. And that has certainly slowed down our track record because we haven't been quite sure exactly how to proceed or what to prioritize with various different DFIs. And then I would say, I think another challenge to working with the DFIs is, you know, I think their mandates limit exactly how catalytic they can be. We need people that are willing to take risk in transaction structures. We'd have to act radically. We have to act boldly in order to tackle the climate crisis and to tackle it fairly across all corners of the planet. And therefore, we need folks that are willing to step in and take on some of that risk in order to crowd in other investors whose mandates just make it impossible for them to provide that role. And some DFIs or some pockets of funding from the DFIs are doing that very, very well. I think more broadly, there's still work to be done. I think there's a broader role that the DFIs or governments in general can play there. To pivot back to the question about how have we changed how we're structuring, one thing that we've learned is it really, really helps to start working with our catalytic investors early to address the two issues that I just pointed out. Is the risk return profile the right fit for a partner? Does it fit their climate mandate? So bringing them in early into the structure, into the structuring conversations, co-creating, as we like to call it, with them to ensure that the final product meets their priorities, their mandate, their risk return profile, increases the chance that we'll have a successful transaction at the end of the day.
Thank you. And you bring up a really good point that transactions that have a DFI under their current mandate alone might not get us there. And in the definition of blended finance, we're saying, is this a transaction in which somebody has done something not on market terms? So a lot of DFI transactions are a good development finance, not necessarily concessionally priced. And what you're saying, I think, is that from some corner, we need to actually have a deeper level of concessionality to make some of these things happen. And you're going to have to start earlier to understand where that's coming from and what that money is willing to do. That's really helpful. Thank you, Lauren. I'm going to turn to Shell Foundation next. Shell Foundation actually shows up a lot in our statistics in blended finance among the foundations. And historically, I'm familiar with Shell Foundation doing a lot of early stage disruptive mitigation finance. And now I see that you've increasingly integrated an adaptation focus as well. Can you talk about what you think is the biggest opportunity in blended finance? Are the risks different during mitigation and adaptation? Before you answer, let me just ask whoever is not on mute. If you could please go on mute, that would be terrific. And we also, don't forget, we have Q&A at the end. So perhaps if you're starting to accumulate some questions, go ahead and put those in the chat line. But over to you, Tanya, about what the biggest opportunities are and about your shift moving from mitigation alone to also looking more at adaptation.
Thank you, Joanne. So I'll talk about both the things. First, how our work in agriculture and adaptation started, and then the role of blended finance for both mitigation and adaptation, how we see it. So I think our overall focus, as you've mentioned, has been on energy access, and we've primarily worked in emerging markets in sub-Saharan Africa and India. So our focus in agriculture came from understanding and recognizing the market size of smallholder farmers in our focus geographies, as well as the outsized impact that energy can have on improving agricultural productivity, preventing food loss, improving resilience and incomes. So, and when we started looking at smallholder farmers as a customer segment, our key learning was that the challenge that is top of mind for this customer segment is it's mostly linked to climate change risks that they're facing. These risks are persistent, but they're increasing, and they're also long term. So, for example, increasing weather risk, increasing water stress, degrading soil quality. This is all top of mind for most smallholder farmers, and this can only be solved via long-term solutions that build resilience. And so we started focusing a lot more on climate adaptation, on understanding climate adaptation, how to catalyze finance for adaptation, and the role that energy-linked products or the energy agri-nexus can play in it. So while our agriculture work was kind of our inlet into working in adaptation, we hope that we can implement these learnings across our energy access portfolio in the future, and it's not just limited to agriculture. So I guess in case of blended finance, some observations is blended finance is essentially a way to reduce risk for commercial investors. So when working in energy access in emerging markets, which we would primarily brand as mitigation, the primary risk which catalytic capital can reduce is the geography or the customer risk that has been spoken about. So the country risk, a new sector risk, a customer risk, which can be real or perceived. But in case of adaptation, there is the additional timeline mismatch, which we've seen. So private sector investments and often even quite a few philanthropic organizations want to see short-term time-bound results and impact, but adaptation impact takes a lot of time to be realized and to be demonstrated. So blended finance can play a role in reducing that risk as well. The other risk which I would like to flag, which is common for adaptation and mitigation, is around the scale of projects. So projects in emerging markets in climate, regardless of mitigation or adaptation, are mostly early stage, are decentralized, or essentially much smaller scale than what international climate finance investors would like to look at. So there needs to be some sort of aggregation or intermediary role, which again, blended finance vehicles can play that role. So, and can reduce that risk as well.
Thank you. And the point about timeline risk, it is sort of the silent problem, right? Because so much does unfold so gradually in some of these transactions. So that's an interesting role for blended finance to come in. It's not a measurable risk in the way that so many of the others are, but it's very real indeed. So I appreciate you bringing that point out particularly. Kruskaya at IFC, I want to turn to you next. One of the things we talk about in our report is that trade-off conceptually. A lot of the climate blended finance transactions are in middle income countries, but we know that the impact of climate change is felt very severely by low income countries. And so how does IFC, a premier development bank, navigate where you prioritize blended finance for climate? I mean, obviously, when you're doing blended finance, you're using concessional resources placed in your care. So where do you aim those resources, and what trade-offs do you consider? What trade-offs do you see?
Thank you very much, John, and to Convergence and the team. I think it's really, great to see all the data that you're collecting and putting out. I mean, it's helping tremendously the ecosystem. So let me start with that. Second, since we have been talking about, the MDBs and DFIs and the catalytic capital that they hold, just to, confirm that I basically lead the work that IFC does with that catalytic capital. So the capital that we are entrusted by, donor partners and, some philanthropies to allow us to take risks that otherwise we will not be able to take on commercial basis. So we are able to take the concessionality. On the specific questions on, middle income countries or upper middle income countries and low income countries, I think it's very important to highlight that probably it is a reality that exists and it has existed for a while, but it is shifting. So, just to give you an example, before we were able to have the resources dedicated to our lowest income countries and fragile situations through what we call the IDA private sector window, most of the work that IFC did on blended finance for climate was in the middle income countries, much of it in the upper middle income countries. When, we receive that ability to either do things globally, we have some, bilateral facilities with Canada, with Finland, with the UK that allow us to go into both, middle-income countries and lower middle-income countries. We have seen that over time, our, portfolio has significantly shifted now to the low-income countries. Also, as we were talking about instruments and patient capital, from mostly having senior loans in our toolbox with a small discount in interest rates, we have shifted quite a lot to what we call the de-risking instruments, which is, the patient capital, the concessional equity, structures that we have put there, a lot of guarantees that we have been able to put in particular on pool basis to help mobilize at much bigger scales. So I think what it's important to think, when we consider whether we want to mobilize private capital is what is the business model that will make sense for them, more easily. And I think that's an important, consideration. And what are some of the areas of the climate finance space where it is more ready? Whether it is readier to get that commercial capital, or that, some elements of climate smart agriculture, perhaps it's still a little bit too esoteric, if I can put it in those terms, for, a significant amounts of, institutional capital to come in. When you come into the infrastructure space, I think it's a much easier, conversation, to have. We have also increased quite a bit our work on upstream, because the moment that you need to capture some of these projects, in particular when you're thinking about adaptation finance, is at the moment that they are being developed. Are they being designed in a way that it's resilient and adaptive? And, what is the cost implication of having that? So I think that's another important element of thinking about, how do we work upstream? How do we think about, governments and other stakeholders to also help us promote that aspect of this. I saw in some of the statistics that were presented that, there was, this consideration that is quite a significant decrease that we are seeing. In IFC, we are seeing a little bit of the opposite. So if you take in 2018, we were supporting about 6% of the volume that IFC did in climate with blended finance concessional structures. Last year we were able to do 14%. What is the right number? Do we need to scale up, significantly? Probably yes. But that is another point that we see. Today, we have significant resources that can be deployed in the lowest income countries. So we can think about, how we expand our toolbox in that. Where we are very short of resources at this moment in time is for mitigation projects in newer technologies in the middle income countries. And I think it cannot be a conversation of either or, do we support only the low income countries? Do we move, climate in the middle income countries? It has to be a conversation about, how do we do both? And because, of that, how do we do both also in mitigation and adaptation? So, we need to tackle that with equal urgency, I think, on both aspects.
Thanks, Kriskaya. Really interesting on all counts. There is a question that's popped up in the chat, and I'll just flag it for you, and perhaps when we come back to you, you can hit on it. But the question is essentially, IFC has done a lot of work with Canada and Finland with use of their concessional resources placed in your care. And the question was whether you can think of any examples where you've used that money to construct transactions that brought in additional third-party money into transactions. So let me park that with you and we'll come back on it. I do want to come back to Allianz and ask Leticia if you can tell us, we hear over and over about the lack of bankable opportunities, specifically in adaptation. What do you think would be helpful to attract more private investors into adaptation-focused investments? In fact, you just heard Kriskaya saying that perhaps ag-related adaptation investments are going to be tough to attract people into. So why don't you speak to us from the institutional investor's point of view and tell us what might be needed to tackle that area of the climate change investing world?
Sure. I think maybe one of the things to start with, and as shown in the report outcomes, is that generally there's been less opportunities to invest in adaptation. So it hasn't really necessarily been an issue of investors not wanting to invest in adaptation projects, but more about whether there's been, I don't know if, to be honest, I'm not sure if it's a lack of focus that traditionally has not been placed on adaptation projects, or generally a lack of pipeline of bankable projects, as you were mentioning, Joan. So I think from that perspective, and my answer maybe is a bit simple, but from an investor's side, there is quite a lot of interest in investing in adaptation. There's quite a lot of discussion as well about having resilient portfolios, climate resiliency, and this is also in the context of what I was mentioning before about net zero commitments and generally commitments towards climate. So I think there's a willingness from investors to invest in this sector or subsector, if I can call it that way. So there's really just a lack of business case or a lack of bankable projects that we have found, at least at scale. I totally agree with Kriskaya's point that adaptation, in some cases, we've seen an approach to adaptation as a pure play. So meaning you only invest in something for adaptation purposes. And it is often very hard to make the numbers work when we're looking at just adaptation, because that's not necessarily a revenue generating activity in itself. I'm making general statements, but that might not necessarily generate sufficient revenue to make the returns work. So what we find that now, as there's increasing focus on adaptation, is what Kriskaya mentioned about embedding adaptation within a project already. So it's not about building a project, a building, for example, in the middle of a flood-prone area and then trying to build around it just poles to avoid the flooding. It's more about how do you think about building a hospital that already accounts for that flood risk or already accounts for hurricane risk, so that honestly it might be more costly upfront, but overall we know that in the long term it's a lot more beneficial. So I think that's probably the one thing that I can mention, and this is, blended finance overall comes into play. I don't think there's a specific need for de-risking adaptation risk. I think it's just overall the concept of the risk that the project would be exposed to, sponsors, off-takers, depending on what we're talking about. But if we embed adaptation considerations within a project, I think that's the best way that we can catalyze sufficient capital towards that.
Yeah, it might not end up having a label as an adaptation project, but to the extent, and this is one of the things we say in our report, is really everybody on the investing side needs to get in the practice of embedding questions like this into your due diligence and embedding questions like this into your management of your portfolio of investments. So I think that's a really a good reflection. And then Lauren, building off Letitia's point, NatureVest has used blended finance to do completely investable adaptation-focused projects such as blue bonds. You've done a series of them now. And you mentioned a moment ago that DFC was in the most recent one, I think. What's next for you in trying to aim private investment into adaptation and conservation? You've just heard Letitia's comment. What does NatureVest have up its sleeve in terms of using blended finance as a tool to draw more investment into this area of adaptation?
Yeah, great question. So obviously we're going to continue to focus on blue bonds. We have a pipeline of blue bonds, and that's going to continue to be a large focus for us at the Nature Conservancy. But broadening beyond blue bonds, it's tricky, and kind of to build on what Leticia was saying, it's not as obviously financeable. The business case is not always quite as obvious as mitigation, a lot of mitigation opportunities. And so this is something that we've been really batting around quite a bit at NatureVest, in particular around, how to use natural capital for adaptation. I would say one opportunity that we've really recently identified, and it jives really well with what you guys showed in your report, as the agriculture space kind of coming to the top with regards to adaptation. What we've noted is that a lot of the corporates who rely on agricultural supply chains are very, very motivated to adapt their supply chains to climate change, to the fact that a lot of times, they're just plowing through lands and basically using it up and then have to go find new land, which is not financially sustainable or environmentally sustainable. And so what we found is they're starting to be willing to come to the table to explore opportunities for financing mechanisms to help members of their supply chain, which are usually farmers, adapt their practices. And they're willing, because they are very motivated at the end of the day by their kind of ends, their bottom line, to play a kind of first loss role, or they're willing to blend themselves into the structure to take on more risk in order to provide this financing, because at the end of the day, it helps them keep their business afloat going forward. And so that's a really interesting angle that I think has just, at least for us, started to appear as an opportunity for us to explore financing in a space that previously had just not been bankable. It had been too risky. We weren't able to tackle it at scale. And it's something that we are focusing on quite actively in our pipeline. And I think it's a new type of blended finance than what we'd been seeing before, where it's a corporates had historically been very risk averse, now have a motivation to play a more risk on role in a financing structure because they benefit on the other side of the structure. So that's quite an interesting twist. I would also just say, just to build on what Leticia said, I think there's also opportunities for us in the infrastructure space around siting. Before the problem is there, are there opportunities to build conservation into infrastructure projects early? We have done that successfully in a pilot opportunity in Africa. We're looking at opportunities to expand on that, where you really think about the broader implications of the siting of the infrastructure. Are there ways to tweak that a little bit to A, take into account broader conservation, but also B, build in adaptation considerations into the infrastructure projects? And that's something where the science that the Nature Conservancy has at our fingertips can be really helpful to partners. And so that we've been looking to kind of structure opportunities where we blend TNC skills with partners for-profit skills.
Very interesting. Yeah, in a sense, the corporates you're talking about are already exposed and are already perhaps in an unmeasurable way taking a first loss position. So why not get them involved in bringing other capital to the equation? Also, what you just talked about demonstrates that blended finance is not the tool for everything, right? There is also a need for everybody to be getting smarter about climate and building these things into their assessment and into their thinking. It's not that there is just one magic solution for all of these things. I'm going to be very quick, but I want to ask a couple more questions. So if we could just keep the responses quite short. Can I please go back to Tanya? You shared in our report that one of the issues for you is the lack of standardized measurement frameworks and KPIs. So if you're going to do a blended finance deal, there's some money in the deal that wants to see impact, and that's why they're there. So if there are not standardized measurement frameworks or KPIs, it's harder for donors and investors to organize themselves and agree on what they're trying to get done. So what is Shell Foundation doing in that realm to better measure, standardize KPIs? Can you shine some light?
Yeah, thanks. So we essentially started a research last year with Duke University. This was under our agriculture program with FCDO, which showed us it essentially pointed us to this gap in standardized KPIs and taxonomy for adaptation. So essentially what's also in your report around what you can't measure, you can't really fund. And we also try to compare how this contrasts with mitigation. So while in mitigation, you have GHG, which is relatively easy to measure, although not without its own challenges. Adaptation is much more complex to define and measure and much more customized at local levels. So we've kicked off a second phase of research this year, and there we are trying to develop a few templates or guidance around what are the robust, what are the replicable standards for impact evaluations that are required in adaptation, and what is required by climate investors, what is required by public sector actors, and align all of them together. But also look at what is pragmatic and feasible for small scale organizations to measure and demonstrate, because we don't want extremely expensive impact evaluations as well. So we're trying to balance these expectations and understand what is that replicable and robust evaluation look like, and it could be different for different cases. There are also multiple excellent working groups of investors working on this challenge. So there is already collaboration underway in this ecosystem. While early last year, we saw a lot of investors developing their own customized frameworks to measure adaptation. We're seeing a lot more collaboration this year. So that's a positive trend. And we'll try to bring that aspect also into our research. So hopefully we'll have some findings to share next year.
Thank you very much. Yeah, there's a triangulation that's needed, right, between what a project sponsor can realistically do, what donors are expecting, and what the private sector needs to have in order to record the impact on their terms. Coming back to Kriskaya for a moment, talk to us about transparency. It seems that from Convergence's point of view as a field builder, we have a lot of difficulty accessing data, either going into transactions or also in the ex post findings. Can you share with us a bit about what IFC is doing to increase transparency around reporting in the climate investing space?
Thank you very much, John, and thank you for the questions, because you know that, IFC and, in particular on the blended finance stage, we are very passionate about governance disciplines and transparency, because again, if we need this catalytic capital, it could be important to know when it is coming, in what form it is coming, what level of concessionality we are requiring for these transactions, so that we can replicate them. And to date, IFC is the only institution that is disclosing that level of subsidy that we are putting in. We're calculating it and disclosing it. As we try to scale up this in the climate space, we need a number of different things, not only on the blended finance side, but as you say, on the impact measurement. And I think that's an important aspect that I think as DFIs, we are using blended finance alongside, our capital. So from that perspective, perhaps we have an advantage that some of the impact measurements are the same. We are using the GHGs, we are using, basically the energy output, we are using, jobs provided. So probably, from that perspective, we are able to be a little bit more specific in what we are achieving. But absolutely, you are correct that we need to put together that. I think you and I just recently also spoke about the need even to just ensure consistency of data, because potentially there is a lot of data out there that we just need to ensure that it is consistently put together. And I think, we, with the DFI working group of blended concessional finance, we have been doing that for 5 years. And I think that it is important again to, coordinate with you and with others that are putting information in the system to ensure that at least the information that is there is being used consistently, and that all of us, have a good body of knowledge, and then take it up from there.
Exactly. Yeah, thank you. I am going to open up the floor to questions from the audience. We already have a couple of interesting ones. This is going to stray a little bit out of Convergence's field of expertise, but one of the questions that came up is interesting nonetheless, and perhaps can be addressed. The question came for Allianz, actually. Do you see a trend in regulation that allows regulated investors like you to use blended finance to go into some of the countries that are otherwise quite challenging for you? Is there an opportunity for you or development banks like IFC or even Convergence to get more active, to lower the regulatory barriers? Perhaps you could comment on that intersection between regulation and use of blended finance.
Sure. No, I'm happy to jump in. There's a couple of, regulation being a broad term, so maybe to put it into different contexts. I think on the positive side, there is increasing, in Europe specifically, I'll focus on that, there's increasing environmental regulation, so the EU taxonomy and the SFDR that maybe some might be familiar with. There's increasing regulation around how to measure impact, how to measure ESG criteria, KPIs, different principal adverse indicators. So there's more and more regulation that is coming in to avoid greenwashing and impact washing, which I think can be quite positive. I don't know if everyone sees it that way, but I think it can be quite positive in order to also provide some sort of consistency in the market. And while it isn't necessarily focused on blended finance or emerging markets, really, for that matter, it is very much something that is at the forefront of some of our investors' minds, and is essentially moving them towards looking for more sustainable investments. And in many cases, that can be considering blended finance. On the other hand, when I think about more of the regulation related to capital charges and risk capital, there is definitely not, at least not that I'm aware of, any push for blended finance type of structures. In many cases, that is actually an issue that we face when we're structuring vehicles for blended finance, where in the case, for example, of European insurance companies that are subject to Solvency II, they are very discouraged from investing in securitization vehicles. EU securitization vehicles because of the type of risk capital that is associated with that, which tends to be really high. And when you think about the returns and the risk capital, it doesn't add up. So I would say that from a risk capital regulation, there isn't anything that is promoting blended finance. And if anything, it can actually make the structuring of blended finance vehicles more complicated. But on the positive, the European regulation on sustainability and environmental and social investments can be a positive, bringing investors towards this asset class.
Yeah, that's a shame on the securitization, because obviously if you blend once at a big scale, you don't have to spend a lot of time designing down on the project level. You know, if you do a securitization, that's in one fell swoop, a large blend of different kinds of capital. So that is unfortunate. Kruskaya, there had been a question about whether in IFC's use of concessional money, for example, from Canada or other sources, whether you've had opportunities to use that to draw in private sector co-investors alongside. And I don't know if you've had a moment to think about that question, if you'd like to address it.
Thank you, John. And I want to, confirm that is the case. In every transaction that we come, we want with that mentality of crowding in. That's one of the DFI enhanced principles, in addition to minimizing concessionality. So, I'll take an example of the use, because I saw another question on performance-based incentives. I mean, this is something that we have used, very effectively in the climate space, for example, in green buildings, in which the capital is coming, from IFC, a DFI, perhaps other DFIs, but also from the domestic, banks, pure private that are coming in and providing that, and also money is coming in from developers. And the use of performance-based incentives to ensure that, that building is green has been a way, basically to catalyze and to ensure that they are building, that. We have used it, similarly in the area of, green buildings through private equity fund. So we do try to ensure that, it is, in some cases, it will be the DFIs on commercial basis, and that's just the reality in some, contexts. But as much as we can, we're trying to ensure that, there is private capital in addition to what the sponsor private sector is coming in, that is coming through domestic bank, through private, sector, or co-investors that are coming alongside.
Thank you. Do any of you want to comment on what you see going forward? We're in a difficult moment globally with a bunch of different emergencies and catastrophes upon us. What expectations does each of you have for your institute? We could do maybe a lightning round. Are you going to be doubling down on mitigation finance, adaptation finance, and the use of blended finance, or backing off in our markets that we're talking about here today? Just very quickly, if we could go around the room, and maybe I'll start with Lauren, just because you're the first face on my screen, not for any other reason. And
sure.
And Kruskaya, please go ahead.
Sure. Well, I mean, I think it's this interesting, just looking at the macro environment more broadly, I think there's a bunch of things going on. Obviously, there's a macro cooling going on. And then I think in the climate space as well, especially as we look at specifically carbon offsets, I think there's also a lot of question marks around the utility of the markets. There's a lot of things that need to change or be improved, shall we say, about the markets before there's kind of a widespread trust in them. And so I think there's macro cooling and then hesitancy around exactly how much to lean in, particularly on things like the carbon markets, which are incredibly important to us, the Nature Conservancy. And so I think we are expecting to see, a bit more of a tepid, approach to deals. I think that being said, I'm expecting to see it cool off more at kind of the broader kind of scaled opportunities that we were targeting more at institutional investors. Whereas I think the blended finance transactions, which are a bit more catalytic, which are digging deep more into supporters that are more impact driven for whatever reason, I am hopeful that those will continue to be, robustly supported, but to be determined.
Thank you. The reason I'm asking all of you, by the way, is because people keep asking us. So I thought I'd ask the experts. Okay, next up.
I'll go next. So I think similar to Lauren, I think for us, at least from our organization's perspective, because our mandate is to focus on energy access and improving incomes of customers in emerging markets. I think for us, our focus on climate is doubling down, both from a mitigation and adaptation perspective. I think in the markets that we work in, you can't work on mitigation without having an adaptation lens as well. So, and I think the role of blended finance kind of becomes more important in this market scenario, or at least the role of catalytic capital. So I see, at least from our organization's perspective, us doubling down. And I think it's also a good time, as Lauren mentioned, to test some of the new structures or instruments at smaller scale till the macroeconomic conditions improve and investors are ready to see more de-risked structures, essentially.
And Kruzgaya, what do you think? What's your prediction?
My prediction, again, it's very much in line and probably very positive in the sense that, we do see, our development partners, the donors are, very much interested in continuing with this support on catalytic capital. And then if you combine that with the counter-cyclical role and mandate that, as an MDB DFI we have, I think, at least my sense is that we are very much in there. And I think the statistics that I mentioned, that we are basically increasing our support on the blended finance for climate from 6% to 14%, just, is one of those trends that, at least from our perspective, we expect to be increasing.
Thank you. And finally, Letitia, from a purely private sector investing point of view, what do you think the trend will be?
I want to continue the positive energy that everyone is bringing to the panel. I do think that from a climate perspective, there will continue to be quite a bit of focus from our investors, and I think increasingly so. We'll see, what's announced in COP27 in a few weeks, but I do think that because of all the things that we've discussed already, there will continue to be quite a lot of focus on climate, both on the mitigation and adaptation. I think maybe on the less positive note, one of the things that we're very cognizant of is the macroeconomic environment that has really nothing to do with blended finance specifically as an asset class or an instrument, but we do see for quite a lot of our investors that there's, at least probably for the first, what I'm hoping are few months or maybe a couple, as the capital markets continue to be quite volatile, that's impacting a lot of our investors' portfolios and asset allocation. So things that are very much liquid, illiquid, what asset classes do you want to invest in, and private markets and long-term illiquid assets tends to be quite a challenge. So just from a more realistic point of view, that might affect some of the fundraising, but overall, I'm positive that we'll hopefully turn that around and climate will continue to be a key topic.
Well, we certainly hope so. And at Convergence, we're obviously geared to try to support a positive trend in any way we can. Final request for any questions coming in, and then we will wrap up if there are no immediate questions. Let me just make sure I think we have kept up more or less with the questions that have come in. I am going to thank the panelists for your great contributions to the field and to this conversation. We really appreciate hearing from your voices in the front lines. Obviously, as a field builder, we're just there to support you. I want to close out by also thanking all of the institutions who contributed to our report, as well as my team for all of the hard work that got this report out to you today. Let me remind everybody where you can find our report. Again, it's at www.convergence.finance/resource. And you'll note that we did spend 99% of the report on the climate space. However, on our website, we always have a map of all of our data. There's a Blended Finance 101 page that you can find at www.convergence.finance/blended-finance. So you can see if you are in the health and education sphere, or you only work in Latin America, or you only work in funds, you can kind of see what your part of the blended finance field looks like, regardless of whether it's climate or not. So thank you all very much for being a part of this launch event with us. And we look forward to hearing from everybody and continuing to support all of you as you go about trying to make investments happen. So thank you very much.